So, Andrew, great to see you.
Great to see you guys as well.
Yeah. So, we've been running a bunch of events, the open coffees. You do the cigars and startups. We do the lean startup thing. We do the angel conference thing. And every time we engage with a startup and we start feeling around, we start asking for numbers. And almost always those numbers are somewhat underwhelming in important ways, not because they're not numbers, but because we don't believe the numbers in various ways. So I'm looking forward to understanding how you can help people understand when they should believe the numbers. Can you sort of introduce yourself and Z Accounting and then just dive straight into talking about the topic?
Sure, I actually have an introduction slide if you'd like me to present. Um, so I'll share my window. Hopefully everyone sees the great Seattle Angel Conference logo and financials for fundraising. Oops. So I'm the founder of Z Accounting. We work with now over 200 startups, many of which are angel funded and venture funded. I previously ran an angel investment group before I started Z Accounting. And I also would work for I work for Coinstar in their innovation group, launching a coffee kiosk business. So I've even done the financial reporting for big corporations and such. I've prepared this deck, and I'm also a dad. I have 2 kids and a beautiful wife. Um, I prepared this deck, and I've got about 25 slides, and I thought I would run through a little bit about what you're fundraising for, and then run through all the different types of financials that we have as a startup and in anticipation of those sort of fundraising financials that you'll want to create, and also some of the other supporting documents. It looks like a lot of people on the call are investors, and this was kind of created from the entrepreneur's perspective, since a lot of the previous SAC events that I've done with John have been, pretty founder focused on how do we meet that investor, how do we get that investor. And so that was the original context, but I'll work to also give an investor perspective in places where appropriate. I have made some investments, but I try not to make investments because when you're working with over 200 startups, the exuberance of working with new clients can send you down some rabbit holes that may or may not be great. And I'm blinded because every startup that I work with, their accounting is so great. They pass all my financial metrics. So let's dive right into it. And so some of this stuff may be kind of rudimentary, but I think it's important to sort of right size what are financials. And so the most common financials that people are tracking is definitely your income statement, your profit and loss, sort of where the money comes in, where it goes out. And I think of this sort of like running a marathon, right? You're running, and throughout the day you're moving a leg and you're gaining further across on the marathon till exit or till the next milestone. As opposed to the balance sheet is when you take a quick stop to drink the water from the little stand and look back and see how far you went. And so the balance sheet really gives you a snapshot of the business at a point in time of your assets, your liabilities, and your owner's equity account. And then the third common statement is the statement of cash flows. The statement of cash flows reconciles the differences between your income statement and your balance sheet. And so the statement of cash flows, which, for a lot of startups, since they're working out of cash, mostly they're not having long-term receivables, and they're not typically getting terms with their vendors. The only thing you'd really see on the statement of cash flows will be those financing rounds, and you'll only see those during the period that the financing rounds happened. So oftentimes the statement of cash flow is essentially blank or very, very limited. The next one, the statement of owner's equity, that's kind of a term, thinking of publicly traded companies. A lot of founders would probably call it their cap table. And then that shows the various shares of stock, and it is considered one of the 4 financial statements. Other documents, we're going to be looking at your financial model, and I think this will be a great one for investors to really focus on and for founders to focus on. But really, you're not doing financials just for the fun of working with an accountant and getting to try on the cool green visor. You're really doing financials and all of these to manage your business better. And particularly the financial model is a document of conversation. Like, this helps the investors understand how you're thinking about your business. And for the investors, this helps you understand, the numbers in the financial model are clearly wrong. We've never had a financial model that's been correct. I don't think anyone has, right? The same sort of as your budgets at companies, right? You can get close, but you're not going to get perfect. But it'll give you a view of how the founders are thinking about their business, and particularly how big and how fast they think that the business will grow. And then there's a whole bunch of other sort of documents around cost modeling. So looking at what's your contribution from your sales after your expenses. Sorry, I've got that text message thing that's just dinging me. My wife's checking. Are you okay? It's late. And then there's a whole bunch of what I'd call sort of compliance reporting. So all your tax reporting and payroll reporting, and stuff like that. And I do want to say, do not, for founders, if you pay employees, make sure you pay the payroll taxes, because that follows you everywhere you go. And investors, watch out for the payroll taxes, because particularly the trust fund accounts, which are the employee withholdings, they'll chase people down for those. So when going through financing, there's three major things that investors are looking for. They're looking for, up here in the upper left-hand corner, a great team, usually a hustler, a hacker, and an organizer who keeps everyone together. You're looking for results, that guy in the middle, that when the founders say that their software does something, it does actually do that, or they're on a path to make that happen. And that there's traction, there's customer demand, there's people camping out to get the product of the startups. And then in terms of funding, and I'm going to jump through every other aspect about funding to the two types of funding that we typically use. And there's sort of a third type that sort of straddles in between, but there's debt funding and equity funding. And then the third one that's sort of debt, sort of equity is called the SAFE. And then John will point out there's a couple more variations to these three primary modes of funding. But essentially, everyone's trying to get to equity in a positive scenario so that they sell the company. Convertible debt, I always love to talk about convertible debt as a bridge to funding. Convertible debt by itself, I would not consider a fundraising round, because convertible debt has to convert to something. And so when you're thinking about convertible debt, you have to be thinking about the future equity round. And so I would encourage investors, when they're talking about convertible debt, to also think about what's the likelihood that the founders are going to get the milestones to get that next funding round that I'll convert to. We had a client that's a marketing firm out of California. They've done super well. They're starting to do angel investing. And they got a term sheet where the convertible debt was payable back to the investors at the founder's decision. And so the investors ended up walking away from the deal, because if they would have made this convertible debt investment of $500,000 between them and other investors, and the founders did super well, they could just pay off the convertible debt. And so not looking at that conversion could get you in trouble. And so they ended up walking away from the meeting because they thought that the founders were going to hose the investors. I told them that probably wasn't a likely scenario, but they didn't want to take the risk. In terms of equity, I put a picture here of a nice Amish family. And when you're thinking about equity, a lot of people think about taking a pie and cutting the pie into slices and handing them out at each fundraising round. And so as a founder, you think, well, geez, if I have to give out 20% at the first round and then another 20% at the second round, pretty soon I'm going to have no pie. Whereas I think of equity fundraising more as in making Amish bread. So if you know the story of Amish bread, you take sort of a bread starter and you add more flour and more water to it, and then you bake the bread and it gets bigger, and then you share your bread starter with another family, and every time that you add more flour and water, the bread itself gets bigger, and hopefully while you're baking the bread and executing on your startup, that bread is growing and growing and growing. So each additional amount of flour and water, and maybe sugar too, because sugar is great, each additional amount of flour and water continues to grow that bread larger. And then a safe, the reason why a safe isn't really debt and isn't really equity is because a safe is essentially a simple agreement for future equity. So a safe is a document that says, if you invest money now, we promise someday we'll give you equity for this money. And it's really like a 1 or 2 page document. And we can come back to this, but I've had a lot of investors tell me, like, why would I ever take a safe? Because I'm really not getting anything other than a future promise that I'm going to get something maybe, right? And so the cases that I've seen a safe be very valuable is, we had a startup that was building cellular technology, right? And they were creating a technology that allowed you to activate devices remotely, right? So typically you get your cell phone, you call in, and then you activate your SIM card. Well, what they allowed you to do, they allowed you to ship the device and activate it from the device itself without having to call in. And so, and then they have the cellular platform. There's an investor that wanted them, there was a company that wanted them to use their cellular backend sort of purchases of T-Mobile's extra space and Verizon's extra space. And so they put a $2 million safe into this company with, hey, we want this to be equity someday, but it gave them an ability to say, hey, look, you've got $2 million, why don't you use us? So it gave them more influence in the company in terms of buying decisions and a seat at the table, but didn't necessarily give them the obligation of control and following up with the startup. Other times is if the deal is just so sexy that you really want to get in, and people are just dying to get into this deal, buying into a safe is a quick seat at the table. And so some venture capitalists may use a safe to get into a deal when they might not otherwise have, it might have been too early of a round for them to get in, not enough money, but it gives them a seat at the table. Essentially, a safe should be called a seat because it gives you a seat at the table in the future. All right, so one of the things that we should dive into also to sort of set the stage is your due diligence package. And so this is a quick thing, everyone quick do your screenshots, but this is a quick bullet list of how how I like to organize due diligence folders. I wouldn't say that they have to be organized like this, but I think this is a great way. And so number one is starting with the financial package. And every entrepreneur should remember the reason investors are investing in your company is because they think that the company will be more valuable after they've invested than before they invested, right? Like you have to think in your mind, the reason these people are giving me money is because they want more money back. And as investors are investing, you have to think about not, whoa, this technology is so cool, I would love to have this, but think of, how am I gonna get this money back? And I always tell investors the safest way not to lose money in startups is not to write a check, right? Because you're never going to lose money that you never wrote. So when you're thinking about investing, think about that ROI of that investment. And again, it's angel funding, and you're being their angel to help them out, but you're not going to be angel funding for a very long time unless you're thinking about how that money recycles and comes back. And understand that at the angel level, you're looking at 12 to 15 years in many cases, particularly in Seattle. I think Concur, it took them 35 years to sell their company. So think that it's a long run, but think about the various times that you'll be able to get money out and the various returns. And that's why financials, I think, are so important. The other information, there's some financial tidbits that are speckled throughout the rest, but I'm going to skip through those. We can talk about those in another session, perhaps. So in terms of the due diligence for financials, there's sort of four major things that I think that your due diligence folder should have for the financial package. And the first one is sort of, what have you done so far? And, we encourage everyone to start a QuickBooks online as soon as they sort of form their company and create their bank account. Because if you start that QuickBooks online, at least all your information is in a place. So if you decide, oh my gosh, we have so much information and so much expenses, we can go hire, Zcounting to go clean it up for us, or you can sort of clean it up if there's a demand to do it on your own. But you'll have to produce your profit and loss statement that shows how much you've invested in the company and where the money has gone. And you'll have to show your balance sheet. So those are probably the two most common that we'll see in there. The next thing is you'll want to have a financial model. And again, I think of the financial model more as a communication tool than an end all. This is our plan of what we're going to do tomorrow. I think of the financial model as having assumptions that you're able to validate, that the investors are able to agree with you on. And as an investor, you should test the assumptions that the founder's making, and assuming that the logic, check, but assuming the logic is correct, that the assumptions roll into the financial model, you can see what that business may look like and what sort of the metrics that are driving revenue and expense, and what the headcount might be at year 3, and what future funding gaps they're going to have. The other thing that's really important that we're always asked, and sometimes it's a financial spreadsheet that we'll create, but a lot of times it's like a super duper PowerPoint slide, and that's the unit economics. I think it's most obvious in a Starbucks scenario. Everyone knows Starbucks. They've got, 25, 30,000 stores. But when you think of Starbucks, you think of their retail store, and the retail store itself should be profitable and should have revenues and expenses and costs that contribute to the overall infrastructure. And so when looking at the unit economics, think about, is what I'm selling actually going to make money? And if not, will economies of scale help it make money? And if not, is there another reason to grow said user base? So there's very few examples that unit economics won't make money or don't make money on a unit scale. Those are kind of like those social media apps like Instagram that will eventually grow and get acquired by Facebook before they actually have to hit a metric. But in general, you're going to want to make sure that what you're selling contributes to a positive gross margin. And then if your company's losing money for the engineering and the infrastructure, that's okay, but just understand that if your product is actually making money. The other thing, and I think that John would really love this type of a report, is taking a look at what your current cash is and what your current expenses are. And I've heard John suggest to do it on a weekly basis, which I absolutely agree with, and that we do for our startups when they're really into to tough situations, or when they're approaching a sort of hitting a rock bottom of cash, is to essentially look at what your cash burn is and when those expenses are coming out on a weekly basis and when the revenues are coming in to help support that cash burn. And so jumping into what you're going to need to show investors and really what investors should be looking for, we've got on the far left here, we've got the one-page executive summary. So and then we've got your PowerPoint deck, and then we've got your financial model. And then the fourth thing is I think you got to be lovable, and you got to build a relationship where the investors trust you and want to hear your music and want to celebrate with you your successes and help you when you're not doing well. And when I'm looking at these 3 documents, the most important thing to me is that these 3 documents are the same exact document. And so my wife's a lawyer. She works at Perkins, right? And so if my wife were to be evaluating startups, she would not know what a financial model was, and she wouldn't be able to tell what the lines are. No offense to lawyers, but she has zero interest in numbers, right? And the PowerPoint deck, she doesn't like PowerPoint decks, but she would love to read the synopsis of what the company is going to be on a one-page slide, right? Someone that's maybe more artsy like my mom. My mom's a dance teacher. She'd love to see pretty pictures in a PowerPoint deck, and she'd love to learn about the company through a 12-step PowerPoint deck that lays out everything the company is going to do. For someone like me, I'm going to dive through the financial model because that's sort of the way that I think. And I think a lot of investors are financially minded. And so I think that the investors will want to read the financial model opposed to the one-page executive summary to really understand how the business works and how it makes money. And so as a founder, think about all three of these documents being the same document. And as an investor, make sure that there's cohesion with the team and cohesion with the documents that you're receiving from founders. And understand that if you send a financial model to my mom, she's not going to know what to do with it, right? Or if you send a PowerPoint deck to my dad, he was an engineer and he worked at a power company, he's not going to want to see another PowerPoint deck. He'd rather have the financial model or the executive summary. So just think about your audience and which document is going to be the best for them. I'm going to skip over these three slides in the interest of time and jump back into the more of the financial stuff. And so this is essentially an example of an income statement. And so you have revenue at the top, you have your cost of goods sold, and you have your gross margin. I've been referring to this metric here, the top three lines, as your unit economics. So this is essentially aggregating all of the unit economics into what's the profit from selling your product that's delivering to your bottom line. And then the next three categories are marketing, engineering, and administrative, with a net income at the very bottom. So your marketing, engineering, and administrative are really your overhead costs. Here's an example of an income statement. And then your balance sheet is assets plus liabilities and owner's equity. It doesn't necessarily have to be 50-50 between liabilities and equity. In a lot of cases, it'll be primarily equity, especially in early stage companies from investment. But what I wanted to show here is that your liabilities and equities add up to your total assets. And here's an example of a balance sheet. So you'll see that the cash, accounts receivable, inventory, property, those are all of your assets. Your liabilities being your accounts payable and your convertible debt and other debts. And then your equity being investor equity and your net loss or net gain from the prior page of your income statement. And you'll see, just make sure, you'll see that the total assets match the total liabilities. And it looks like that's the case across the whole spreadsheet. Phew. All right, a statement of owner's equity. Here is a common cap table looking at common stock for your two founders. You've got investors A, B, and C that have preferred shares. Investor B coerced a warrant to be able to buy shares at a future time for being the lead investor, probably. There's essentially options that were given to the first founder, and then some other options that were given to other founders to create your whole cap table or statement of owner's equity. Cash flow statement has operating activities and investing activities. So operating is, if you're waiting on receivables from your clients. Investing activities is when you're buying assets, and financing activities is when you're getting investment from outside investors. So here's an example of a cash flow statement. So you've got your net earnings, and it reconciles down to your closing balance of cash at the end of the period. And so you add back in non-cash things for, working capital and depreciation. You've got your investments in equipment, you've got your issuance and repayments of debt, and then your cash balance is reconciled back to that net income from your income statement. So the next thing that we're going to do is we're going to talk about the assumptions in financial modeling. And so when you're thinking about financial modeling, because you're predicting the future, you don't really have a source document that you're going to go back to. The profit and loss and income statement, all that stuff is black and white, or mostly black and white, because you have a bank account and financial statements that stuff rolled through. But when we're talking about financial modeling and your financial model and your financial forecasts, you're really dependent on assumptions. And I've been talking about financial modeling for a long time and how to create assumptions. And a lot of people have a real block about, how do I create my financial model? I don't know what to assume. Like, how am I going to convince an investor that what my assumptions are about this company are true? And so you got to think about, what is an assumption that's reasonable and believable and that you have substantiation for. And so when you think about, imagine that we never had bottles of water, right? And that you were trying to prove to investors that you could sell bottles of water. What you could do is you could research the benefits of water at the library, right? And you could go through and say, water is so good for your health. 90% of your body has water. Of course, people would buy bottles of water because there's all this data about how great water is for you. The other thing that you could do, and I think what John Seacrest would prefer that you do, is you could go out to the quad at the UW and set up a table and get paper cups, because you'd only had cups before, and put a plastic saran wrap over the top like a lid, and try and sell those for a penny, a quarter, $1, and see if people would pay for those. And then go through and take the data. 9 out of 10 people was willing to pay us a quarter for a cup of water with a plastic lid on it. So we think if that form factor was a screwable top and a plastic, people would pay for that again. And so both of those are assumptions that you could put into a financial model. One of them is a tested assumption, one of them is a research assumption, and both are okay. So when I'm thinking about a financial model, I like to break the financial model into sort of 3 distinct sections. The first one is laying out all your assumptions on a page, like the first page of your Excel spreadsheet is everything that you assume. We assume that we're going to sell our product for $5. We assume we're going to hire 20 employees. Everything that you assume and dynamic on this page so that it'll flow through your model. Then I like to think about, how are these assumptions going to generate revenue? So as these assumptions are generating revenue, maybe we're saying if we buy a Google ad, which is a marketing expense, it will drive a customer to our website that will go through our funnel and create cash in or revenue. And then once you've really figured out how are we driving this top line revenue, lay out the expenses that get you to that top line revenue, as well as the expenses that are required to support the infrastructure that builds that revenue for you. And then sort of the cash in and cash out is really the juice of the financial model. And then I think it's important to do a monthly summary. So you essentially take all the revenues against all the expenses, and then your annual summary, which is the copy and paste to your PowerPoint deck. And again, this is sort of how I'd lay out a financial model when I'm creating sort of an angel level or seed stage financial model. And that's sort of the end of my presentation, and I'd like to open it up for questions. If anyone has questions about anything that we went over, if I skipped over stuff too fast, or if there's other information that you're just dying to ask.
I want you to dive into the hockey stick. Where do we find the hockey stick? Why don't we believe the hockey stick? And how can they make a real hockey stick?
Yeah, so the hockey stick is the PowerPoint deck, because why would you present financials that didn't have a hockey stick on it in PowerPoint? But if you're thinking about building that hockey stick, we think about when we're building a financial model of what does it take to get that 3x growth in top line revenue over time each year. And so a lot of our models will map to 1, 3, 9, 27, 100 million over 5 years, and sort of that 3x. The reason we use 3x is because Smartsheet did 4x top line revenue growth for many years. I used to talk all about it. And I think that if a company's not growing 3x or doesn't have aspirations to grow 3x per year, they're not growing fast enough and they might not be a venture scale business. In terms of the hockey stick, because the numbers are in there, all models sort of look the same. But I'd like you to look into what are the assumptions that grow to a hockey stick. So as a founder, I'd say, don't just produce a model that backs into 1, 3, 9, 27, 100 million in revenue. Really build the model from the ground up of saying, how many customers is it going to take to get to 1 million in revenue? How many more customers is it going to take to get to 3? And then what are the inputs that drive adding more customers? And a lot of times, we've had a couple times where we've had clients that have gone out to meet with investors and they were looking to, raise $2 million. And the investors that they were targeting were later stage funds and said, hey, we have to put 5 million in. What would you do if we gave you 5 million instead of 2? And in most of the cases, the founders weren't thinking big enough in the first place to actually take that 5 million or weren't ready to, but we go back through and we're able to really quickly drive more cash into marketing, more cash into headcount, which drives more revenue. I see we've got a hand up from Simon.
Hey, thanks for the presentation. That was very informative. My question is on the topic of safes. Why would a startup want to offer them? It seems like a liability that they would just not need to have.
So the idea with safes is that you can go to Y Combinator's website and you can download it and you can share it with investors. The risk is that you're not covering all your T's and crossing all your I's, or vice versa, because it's just a one-page simple agreement for future equity. And so if a founder's using a safe, the reason that founders like using safes is because it's quick, it's easy, and it's ideally free. A lot of law firms now, especially the big law firms, can figure out a way to charge you 10 or 15 grand to help you write a safe. But the idea was it's a really quick way to get money into the company with really not a lot of strings attached. And the investors don't get the same protections, nor do the founders have to give the same protections to the safe holders, because it's not a debt instrument and it's not equity. It's literally just a contract between founders and individuals or entities on getting future equity when it eventually converts.
So I guess what you're saying is, for a really early startup and you're really tight for cash, you're just kind of like scrapping it out. This gives the advantage of saying, hey, you know what, we'll give you some money. When you get around to it, then we can do up the legal stuff. But right now, let's just focus on pushing it through. Would that be fair?
So I think that's dangerous because you're going to be tempted to take unaccredited investors.
No, I mean, like, is that like kind of like
in theory, when I've seen it done, it's because there's either someone that comes when they're not fundraising, they're not ready to fundraise, like my example with the strategic investor that says, hey, we're going to do way over 2 million in business next year. We want to give you a head start so you don't have to, get other debt or other equity, and we want a seat at the table eventually, but we just want to have a piece of this pie. And in that point, of course the lawyers had to get involved, but in theory you don't have to get the lawyers involved to take that quick money. Where it was used at Y Combinator was these companies were going through Y Combinator, and when they graduated from Y Combinator they raised like $10 million, right? These are super sexy Stanford, like ex Google, ex Facebook like employees that were starting these companies, right? And they already had a network, and it was kind of like super angel friends and family that they were taking this money in sort of to move quicker and then clean it up later. Um, or you closed your round already and there were investors that couldn't get in and wanted a seat at the next table. And so I don't know. My preference as a founder, because you have this safe that's sort of standing out there, and not a lot of, like, not everyone knows like the safe as good as, you know, the handful of people that are in this room and in San Francisco. And so I feel like the safe would just sort of be this liability that someone doesn't understand and comes back and like thinks that they own your company or thinks that they have more than they really do because they really don't have a lot. And so my advice is, when you're at an early stage, I'd rather just sell common stock at a fair valuation to your friends and family or really early investors, because it sounds more like a friends and family round than an actual angel or Series A. And then you're just giving them common stock, and you're not, you know, it's they can participate with you and they've got the same stock you have and they're really early stage. You know, and it'll cost a little bit more, but you'll have a lot less headaches because they actually own something, and you can say, well, you have shares and the company's doing really great now, or you have shares and it's not doing well, and, you know, whatever, right? There's no obligation. Oh, geez, what do we do with this safe? Do we have to pay it back? Do we not? We got to shut down the business. There's just a lot of stress there.
Cool.
So,
Thank you.
Suresh.
Yeah, hi, Andrew. My question was around how many years of financials do you recommend? When I work with startups, I typically say do no more than 2. I've seen, for example, a lot of 5-year forecasts, and I say to folks that nobody believes 5 years from now you know anything about the business, and that 2 years is sufficient because that's, you know, you're typically raising money for 2 years, and you want to show investors how those funds will be deployed and what kind of results you expect. So that's my recommendation to startups. What is your recommendation? Do you agree or disagree?
Yeah, I like the 5-year model, because in your 5-year model, you're able to say this will be a really huge company, and it's all, like you said, no one believes that your 5-year model is actually correct, but I think that it signals to the investors that these guys, because in a 2-year model, if you went from $1 million to 3, like, that's a really good job, and it's on that 3x line, the trajectory line, the hockey stick line. But the problem is if your model's tapping out at 3 million, are the founders going to be stoked to be making 3 million and taking home a salary of 100 grand a year? But if you're presenting to the investors, we think this business will get to $100 million, they should be excited and exuberant about it. And you should be able to say, okay, if it doesn't get to $100 million, but if their metrics are going well and they can hit 1, 3, and 6, like, that sounds good to me, right? And so I think that the 5-year gives you enough time to really hypothesize the market size and the future growth of the business. So I'd say that, yeah, maybe a 2-year is more realistic. But how many of those 2 years are actually hitting their 2-year metrics either, right? And so if you're just going to make up the next 24 months, why don't you make up the next 60, right? I just think there's no harm in showing that you have big aspirations and you believe you're going to build a huge ass company.
Yeah. Okay. Thanks.
I'd like to chime in. And Andrew, I agree with what you just said. I see that longer term 3 to 5 year plan as a conversation piece to really understand the vision and the growth potential that the founders think about. But then merging that with kind of what Suresh is saying is, like, I look at basically the next 12 months as their executional plan, because it's a little bit more, it incorporates, you know, a higher proportion of known activity, a pipeline, you know, where your next sales coming from, and what your hires are near term, and kind of tells me what they need to do right now to get online.
Yeah, so Suresh, I think I'd agree with both you and John. We should have our financials of what actually happened. We should have our aspirational financial model, but we should also have a cash burn. And maybe, if I bring in John Seacrest, a weekly cash burn to really show when we get this funding, if it takes 3 weeks, here's the bill that we're delaying, or here's how we're paying for that bill that's coming in the 3 weeks of legal review from a large law firm that can't touch your stuff for 2 weeks.
Yeah, so I think that every business should have a weekly review of their 13-week cash flow, right? Essentially the cash and burn. You should know week by week what the health of your company is going to be for the next quarter. And if you're not managing your cash flow with some discipline, it's really easy to get caught in a little bit of a trap where you are selling a lot of stuff and not getting paid fast enough to actually do what you need to do to stay in business. So if you, as a just basic financial discipline, have a 13-week cash flow projection that you update weekly. But that's not necessarily your financial model, which is a 5-year model, which you are updating maybe monthly or maybe quarterly as you learn what's not working in your 13-week cash flow. So different levels of focus on the problem. Other questions from folks?
Hi, I have a question about the cash flow. Very early companies may not have sufficient cash flow to talk about any of the financial models or anything. How do you judge a company in that case? Or are they just too early for investment?
Yeah, so you're talking about they don't have any financial metrics because they've literally been coding in a garage, and so one, I understand that early stage businesses might not have the most beautiful financials and might not be able to show, we've been spending 25% on marketing, engineering, and, administrative burden, and our profit margins X. But I think that these companies should have some sort of evidence of having invested in their company. And so, yeah, they might not have a cash flow statement or built out financials that, show here's our investing activities and such. But I think you should be able to dig up some financials. We've had a handful of founders that have put pretty much their whole business on a credit card for 2 years, and they've spent, hundreds of thousands on these credit cards, and eventually the credit cards are charged off, and you're trying to piece through old PDF statements to rebuild their books. But there was activity and there was flow. If you're losing money and your financials look like you're just losing money every month and you have to keep putting money in, that's okay, because it's an early stage business that hasn't, got funding yet or isn't doing enough sales to cover their overhead burden. And so I'm not sure if I've answered your question, but I think there should always be some level of financials. And I guess if there's no financials whatsoever, I'm having a hard time thinking of a time that would be true. Can you give me an example? It was John, right?
Yes, I'm sorry. Maybe my question was not, I'm not coming from like a from experience or anything. But yes, I think your answer makes sense. That I guess I was thinking more about the revenue side, but you're saying even if there's very little revenue or no revenue, there is still some kind of cash flow on the burn side. So you could still tell your investors what's happening on that side. Is that right?
Yeah, we've had a couple clients that have come through Techstars where they've done sort of one of them actually is Symbol AI, and they've been a client for probably 3 years now since they graduated Techstars. And Symbol AI sits in your Zoom calls or your sort of Zoom meetings, and it has a really smart assistant that will take notes for you, deploy tasks to people. If I say, hey, John Seacrest, I'll send you an email later today. It'll add an event to my calendar and to my Asana to tell me to send that email and track the tasks. And so they were billing by hours used, and it was like pennies an hour. And so when we were going into the fundraising, their total revenue was like, I don't know, like $2,000 a month, but they had a 30-person engineering team, right? And so the revenue was minimal at best, but we focused a lot on the unit economics. For 1 hour of streaming where we're using our AI, it costs us 10 cents, and we're charging the client 35 cents per hour on this streaming. And right now we've only got, $2,000 worth a month. But what happened is when COVID happened and everyone went home, their usage spiked and they went from like 2,000 a month to 35,000 a month pretty quickly. And so because the unit economics held, that produced a lot of cash and got investors really excited. So.
Okay. Great. Thank you so much. It's a great example.
Suresh, do you have another question, or did you forget to put your hand down?
No, I have another question. So the question I have is, are there any business models available on the internet that are appropriate for SaaS companies that you have seen that would be good to start with as opposed to starting from scratch?
Yeah. So, we have. I've got a guy that we just hired that worked in hedge funds and on Wall Street. Young guy, did the grind for 5 or 6 years and decided to sort of go out on his own, and we're leveraging him for some financial modeling. And I asked him, I said, hey, can you just create a template that you can plug and chug these financial models on? And you can, and people always, a lot of the incubators will have sort of fill out this template. But the problem is when you're filling out the template, you're dependent on someone else's company or company type, and you're really trying to match your financials to how someone else thinks about a SaaS model. And so I would encourage you to build your model from the ground up to really represent your company and to really think through how your business is going to get that first customer, that 101st customer, and that 1,001st customer, opposed to trying to match your model to something that's already there. So maybe start out with one of those templatized models to sort of see how they flow. But I really think it's important to start from the ground up and really understand your business and make assumptions on your business. So,
okay,
sorry, no shortcut.
So one of the things that happens is that we get people that have been trained as MBIs and they've been told to go and do their research at the library. By the way, at 9 o'clock tomorrow morning, we have a workshop on where to go in the library to get data. But they go to the library and they figure out that there's billions of these and hundreds of thousands of those, and they do a top-down analysis, and then they stuff that into the spreadsheet, and that's all, quote, researched numbers, but it's completely unvalidated numbers because we're doing something different than that. And so I would like to see more of the fundamentally tested numbers. How do you suggest people distinguish in their documentation what parts of their assumptions are research numbers and which parts of them are pulled out of the air and which parts of them are, we measured this thing?
Yeah, so how we're kind of taking care of that in the models that we're building is we're having the founders create a notes column that says how they validated things or where the assumptions sort of came from. And so like I'm talking about how this is a conversation tool, you're not always going to be there to explain this conversation and to walk through your model with investors. And so giving investors any tool that they have to understand where the assumptions came from. And, we'll put the notes describing, here's how we made these assumptions, here's which ones are validated, here's which ones are not, and then we'll show the assumptions down below. And also we'll have notes off to the side to help the reader of the financial statements read it better. there's other models that have sort of like a good, better, and best scenario that I've seen that have been really sharp, and you can sort of do that good, better, or best on your assumptions. We're picking good on this one because we haven't validated this. We're picking best on this because this is a best class validated assumption. You know, that we've got this great contract with Amazon for this cheap API call. You know, so I think that really just making it easy for people to read is the best. And I think if you're presenting a model to John Seacrest, making sure you point out which ones have been validated and which ones are pie in the sky in a delicate way, that these are thoroughly researched but not yet validated, I think would be very helpful to him. Garrett, I think you're next.
Awesome. I actually love that assumptions and adding notes and doing like some sensitivity analysis on that good, better, best. Kind of going through that right now, and I have a question related to if you are early stage and going after B2B, where like you kind of need some of that performance of like deploying a product and stuff. You can have assumptions and have conversations all day long, but you might need funding before you kind of hit that point. Do you have any tips or suggestions for either like specific mechanisms or people to talk to, or kind of how do you make it to the point where you have demonstrable traction when you need to do a little bit more legwork up front?
Yeah, when I was in Techstars in 2012, we had a company called Builders Cloud. And what we were doing is we were essentially creating a Google Maps for a 30-story construction project, right? And so we had that same problem, is we're not going to sell a $9.99 software solution into Turner's $100 million Amazon building, right? And so what we did was we worked with their innovation group to essentially run sort of free trials with their most innovative people to get some testing out of our product and to show those successes. And I don't know if your product would, I don't know if everyone else knows what you do, but I don't know if in your scenario you could do these free trials and sort of get that traction. Builders Cloud ultimately pivoted because our CEO had a conversation with Sunny Gupta of Aptio when he got $6 million from Madrona to go start Aptio. And the reason he got $6 million to start Aptio was because he went to Chase Bank and convinced Chase Bank to give him $2 million to build the product that Chase Bank and him discussed to go out to, that then he raised money on to essentially make it big enough to sell to other companies. And so there are many cases where there's a really innovative company that needs a solution so bad that they're willing to pre-fund you to build that solution, you know, and get it delivered 6 months later. And so I think that don't be afraid to ask for the money up front to build it, because if you find the right person in these companies, you know, maybe it's a product that they've always wanted to build, but their company wouldn't let them do it, but they have a budget to buy this type of software that's way more than you would have charged them for it anyway. And so we've got another client that's selling, and I don't think I can say their name, but they're essentially selling an internet security solution. And what they were able to do is they were able to get on side of a Department of Defense contract where one of their partner companies or someone that they met had a hole in their solution that they were able to solve. And they'd already started building a little bit, but didn't have a fully baked product. And so they were able to get paid $35,000, which ran the company for about 6 months, to build this product to plug into this solution at Department of Defense, which was really just a test product anyway. And so I would look for scenarios where you can get prepaid to do what you're going to do anyway by a customer.
Well, thank you for that. I see John, the NRE, or non-recurring engineering as well. That makes sense. So I guess like quick follow on then too of like, if you're kind of building something like that where revenues are good, you know, you're in like that, you know, 10 or so million range, it's looking good, some upside, but you might need to pivot. But like you're kind of be lying to yourself and to investors if if you're showing 100 million. Is angel not the right route for funding? Should you go kind of go that other route?
So the lean startup methodology suggests that customer development is what happens before product development. And if you've done your customer development properly, then you have lists and lists and lists of people that are like hungry for your project, and they're throwing money at you, trying to get you to build it now. And if you haven't done your discovery and you haven't figured out your submarket and you haven't figured out what things cause them to move right now to pay you so that you can get non-recurring engineering requests for features, or you can get pre-orders on the product, or you can get consulting gigs that lead into the development of the product, then all of the things that happen later with product development really don't matter because you don't know who your customer is.
Yeah, John Deck's up there. It looks like you raised your hand.
Up here.
Oh, for me, you're in the upper left-hand corner.
Always up and to the left. That's where you want to go. Or is it up to the right? You talked about the pitch, or not the sort of financials package that included pitch deck and a summary. In the pitch deck, what's your best practices or recommendations for, what slides are included, what format they're in, numbers versus charts? I've seen a lot of eye charts, so I guess I'm biasing the answer by saying don't put up a slide you can't read. But what should be in that pitch deck?
All right. Well, I have a slide for that, but because I was talking about financials, I wasn't talking about a pitch deck. Other than it should match what your financial model says, right? But I like to do a pitch deck that's like 12 slides. And I like to think of it as essentially slide 1 is sort of your opening and your grabbing of attention. And I like talking about my problem, right? Like my problem as a founder was always that, no one wanted to do the accounting work. The bookkeeping was a drag. Bills didn't get paid. We didn't know how to pay our taxes at my company. It was just a big pain. And I spent so much time wasting time doing accounting for my
hey, sorry. I just want to I'm not sure I articulated my question. I mean, what's on the financial slide? Or how many, not the whole pitch deck. I don't want to take this in that direction. So if you misunderstood my question, I just wanted to
misunderstood.
clarify.
Yeah. For the financial slide, I'd like to see essentially your revenue, just your hockey stick slide, and then your pertinent information that would have been on the, like something like this, but even with less information. So it rolls up really your salaries and benefits, your expenses, and whatever underneath your hockey stick. So I like to have like 4 or 5 lines down below, and then a hockey stick bar chart up above for the financial slide. And I think that, if you have the numbers for the more analytical person reading it, they can see, oh, we're going to get to, 100 million. And we're going to lose money for the first 3 years, but you'll also see that on the bar chart. That's just my preference.
One of the things that I think is important in that hockey stick is that you're modeling the business and you're out asking for money, and so there should be a discontinuity in the hockey stick. It's not a nice little smooth thing. I just dropped a bunch of cash in there. There should be a discontinuity, and it should change the slope of the business at some point. And then I'm going to drop the next round in, and it should have discontinuity. And so if you're doing your financial modeling in the spreadsheet right, that discontinuity should naturally show up. If you do the 1, 3, 6, 9 solution, you get a nice smooth curve. It looks really good, and there's no details in it, which tells me you didn't do any maturity mapping. You didn't do any consequences of this funding mapping. So when I go in and ask you to adjust it to a slightly different scenario, it's not going to be adjustable because you didn't actually build it from the ground up. Other questions from folks? Deborah, you got your cash flow pro forma built? You're on mute.
Cash flow for the past or going forward?
Going forward.
I'm building
5 years.
I'm building it.
Yeah.
Yes, in progress.
What do you need to know so that you have that all ready so that when Andrew comes and looks at it, he can understand it?
As a med device, we don't have revenue. We have milestones that we have to accomplish that are traction. So the way I think of it is use of funds. So I have to hit certain milestones and it costs interim milestones and it costs me money to get there. So if I lay that out in a schedule, it's a burn rate.
Yeah, then that's all project management stuff that you do to run a project, but they don't tell you whether or not the company is cash flow positive or not. It doesn't tell you margin. And so somewhere in here, there's a real business. So how do you get the business?
But for our next phase, we're not selling product. We have some revenue from our collaboration. So it's a partner collaboration where they're putting money in. So we make assumptions about the mix, what things they would pay for. You might think of them as in kind, but they do have cash value. And like we're going on they will prepay us for development. So in our collaborations. So then if you're spending money, if we pre-invest anything for a collaboration, we have to hit our number. We have to land the collaboration where they're putting their money in to keep going. So those types of things, is that what you're asking about?
Well, I saw a pitch earlier today where they had some nice revenue, but the revenue was coming from a service contract that they had and not from their product. And it sort of derailed the investor interest right there. You could watch the little click, the investor brain turned off. And so what they're looking for is a measure of traction, right? And that traction should then pass through into your revenue structure and go, right? And even with a medical device that has to do a bunch of things, there's other things that you might be able to do that would generate some kind of unique economic validation and traction. And I think you've already done that by selling the products to research labs, right?
Well, that's what we're doing. You know, when we were talking last workshop, where you don't specifically have revenue on a med device because you can't sell it without a FDA clearance, but you can do studies. And so studies have money involved. It costs you money to do the study, and both sides have to put on money. So our traction is around people using that device, which is the same thing as you're talking about, kind of customer development. And because it didn't exist before, they actually pay you to develop it. So we have a piece of it and they're paying for a piece of it to put our technology in their environment and get value out of it. So our model is very similar to what you were talking to about Garrett, or somebody was, where we have to land a contract where people are paying us to essentially do the product. We have a piece of technology that had to be in place for that conversation to even take place. But there's a lot of pieces missing, you know, delivering alerts, who responds to them, who's looking at the data, who's, you know, delivering it to the customer. There's a whole lot of pieces around a complete solution that we don't have. And we're going to do collaborations with people, you could call them studies, pilots, and there's income associated with them. We want them to pay part of it, and we put part of it up too. So there is an income, there is an income.
No, there's no problem with asking them to pay for all of it plus margin, just to put that out there.
Yes, there is. I should speak in those terms. Yes, there's no reason for that. That is correct. That's correct. We agree with you.
Cool. Ali, do you have any questions about how you're going to build your cash flow model so that you can show John Dex a beautiful hockey stick on your harvest?
Well, this is all new to me, so I'm just getting into it.
Yeah, cool. So, Andrew, you had an offer that you were making to some of the Stack folks. Are there any offers you want to make to this group of people? There's only a couple of founders here.
Yeah, so we get QuickBooks wholesale pricing, which they just changed as of July 15th to 30% off of QuickBooks. and we pass that through with a small cost to process the credit card. But if you want to sign up for QuickBooks, I'm happy to get you set up on QuickBooks, and then just pass it through at our cost. The other thing that where people get in trouble, and we have a client that we'd only just started working with them and took over from their bookkeeper who quit during the pandemic. But what they're finding out is during the pandemic, they didn't pay payroll taxes because they were using QuickBooks payroll, and they didn't understand that they needed to have been filing those reports manually and forwarding the payments to the IRS. And the two founders found out they now have personal liability for about $15,000 a quarter. That's going to have a lien against their personal assets because they hadn't paid payroll tax. And so I'm happy to help any founder set up their Gusto account as well, and help them, and again, Gusto's, $40 a month plus some nominal fee per employee. And when you run a payroll through Gusto, it withdraws the payroll taxes at the same time, so you're never getting behind. And so I want to help. We're here to help founders be successful. We want them to be able to trust that they can focus on their business, and we'll take care of all the nitty gritty and accounting. But we charge a fee to do that. But in the meantime, I'm happy to help founders get their QuickBooks set up. I'm happy to help them get set up on Gusto. I just want people to be successful and come back, because if we're already in your QuickBooks and we're already in your payroll records, it's really easy for you to hire us when you get funded. So I'm happy to do those. Also, I'll talk with any entrepreneur for a half hour and sort of give them, my 10 cents on their business, or help them struggle through whatever they're currently struggling with, because I want entrepreneurs to be successful. So if you go to my website, at the top and bottom of the website, you can book a meeting with me through a Calendly link. And if you're a founder and you just want to talk to someone about, ideas or whatnot, feel free to reach out and I'd be happy to talk.
Cool. Thank you.
Investors
Sarah.
too. Dennis Lee has been has scheduled a couple meetings with me too. So
Cool. Sarah, you were asking questions about impact and how you don't have a business model that produces lots of money, but you have a business model that produces a lot of impact. Do you want to ask any questions?
Well, I think the biggest thing is just understanding, as an investor, I know that we have to, the goal is to make them more money. But I also know that there's, I'm in the healthcare system. I think that there should be less money taken out, but you should be solving a solution and making it a cheaper option, but still, your goal is not to make buttloads of money and be, taking from the space, but instead just offering a better solution that also is.
So if you have a solution which is half the price of the competitor, and you put the competitors out of business, you make a lot of money, they don't make any money, and everybody gets cheaper healthcare. So you can make a lot of money, billions of dollars, and in the process of making billions of dollars, make healthcare cheaper for people. So those are not aligned in the order that you had them aligned.
No, yeah, I agree with that. I think the biggest thing is that it's, I think sometimes when you're putting your financial, I guess, like model and trying to get that investment, you're not looking for patients. You're there for patients, you know what I mean? So your goal is to fill a market. Obviously that's a need, but at the same time, it's not our market's Medicaid. It's not going to make us a ton of money on a per customer, but it will be, obviously a large amount, hopefully, because your impact is larger in general,
I have a really hard time with sacrificing profit for impact, because I always think about the people that have created the largest nonprofits in the world, never sacrificed a second for profit. That being Bill Gates and Warren Buffett. Like Warren Buffett's donated like 40 billion to Bill Gates because at every second his 100% focus was on creating profit, and then he's giving away 99% of his money. So he's creating profit to fund his charitable impact, right? So in the same way, Bill Gates and he's trying to like legacy whatever, right? But he's essentially created immense profit to fund impact. And so I would argue with you, and maybe we should do it over beers so it's a little bit less like abrupt, but I would argue with you that the more profitable you can be, the more impact you can make.
I would agree with the way that you explain it. Absolutely. I mean, that would be the goal, but you also put it into the market that you're also addressing in a different way, like so. But yeah, I think like the biggest thing, I think about is whether or not you need two different kind of scenarios where you can be the solution for the revenue, but you can also do like the right thing on the side.
So one of the things that we see is you can have a pretty boring business, but the innovation in your business is in your revenue model, and that you move from one old-fashioned do-it-by-hand kind of solution to everybody waving their phone at you, and it moves very quickly, and then you take pennies, and pennies turn into billions of dollars because there's billions of people waving their cell phones. You can make things more efficient, spend less money total in the system, and still generate very reasonable margins so that you have enough fat to grow. Because businesses that don't have enough fat to grow do not survive, right?
That's the goal. Yes, I totally agree with that. So yeah, I think easily, from what I look at it as our company, it'd be, both will align, but I just wonder in another scenario, my goal is to be always in like kind of that like health equity space that may not always look like that. So I'm just trying to wrap my head around all those scenarios. So thank you for that help.
Well, I think that maybe you and Bob should talk to Elizabeth about workshops on this for the APIS Health Angels, where they dive into some of the issues around this and get some people that have been researching it. And in any case, thank you for letting me pull you out into the conversation. Roland, are you still there?
Yes, I am still here.
So let's suppose that one of these wonderful companies goes through Seattle Angel Conference and they win and they get $200,000 that they're going to spend on their equity to grow their company, and they're short on working capital. And they apply to Business Impact Northwest and get a working capital loan?
Yes, depends on the amount they're applying for.
An extra $200,000 line of credit.
A lot of this is depending on the funding sources that are available at that moment in time. So, for example, right now, the state is about to come to open up for us some funds that we're going to be able to go out with in a range between like $50,000 to $150,000 at fairly low interest, like 4 to 4.5%, and it's going to be collateralized just by whatever assets the company might have, if any. But it's not going to be like collateralized necessarily by real estate or hard assets like on typical loans that we do. So, if you had 200,000 in equity investment and needed to pony up another 100, 150, this might be an avenue, this new funding source that's going to happen. We're still trying to get all the rules laid out on that, because there was one thing in there about having been operational for like a year, which sometimes can cut through things and cause a problem. But this, like having a source like that and having that type of flexibility can change up some things. I'm in the middle of I'm at the end right now. We're actually signing now a project where we're putting in another $80,000 in working capital into a business that has both debt and equity. And there's not a whole lot more collateral that's supporting that. So we've had to turn to an SBA guaranteed loan for this, but just partial guarantee, like 50%. But at the end of the day, how much do I even count on that? I'm not totally sure, because when I looked at the whole picture of this company, what I see is a company that's built out an infrastructure that has like a big distribution infrastructure for their product. And so they built brand and they've built distribution infrastructure, and that's now fairly sizable. And so there's a value to that. In accounting terms, it's like unrecognized gain, because the gain won't actually be recognized until there's an event, a sale event of the company. And so, or of the shares somehow. But when that event takes place, somebody sells the brand or sells the company, the size of what has been built in both brand recognition and distribution level takes this business way up, so that not only is all the debt going to be covered, but all the investors at this point will have probably made I'm thinking it's a 3 to 5x return on their money. So when you look at it that way,
part of the reason part of the reason I asked you was we got a room that's half investors that don't know what a CDFI is, and as a CDFI, you could make an offering to investors for a different part of their assets that they're doing, and allow them to be on the debt side and on the equity side, right?
Well, I'm not quite sure how on the debt side, unless they come in and be part of a fund that we have, which is possible.
Well, one of the things you talked about before was putting in money as a collateral to a loan.
Yeah, well, they would be investing in that way. Yeah, they can do that. That's one possible structure. And other structures to actually go in on some of the loan pools that would be specific, maybe industry or area. So that's another way to do it. Where we're seeing the need more so is to build out, like to do a particular growth project. There's another client of ours that has sort of tapped out on debt and is in the middle of an equity raise, trying to get to a particular number so they can expand their infrastructure, plant and equipment, and so forth to grow their company. So if they've tapped out on debt, the only next place to go is raising more equity. But what I'm pointing out, or trying to, probably not doing too well here, is that as these brands get recognition and as the distribution channels grow big enough, that has a value. So when you first look at the balance sheet, before you take into consideration of all that, your balance sheet could be upside down. You could have negative retained earnings on there from losses, et cetera, but when you add in a pro forma state, the value of that unrecognized gain due to the brand and due to the distribution that would be captured in the sale event, you've now got a really nice looking balance sheet. And excuse me, that's what people are not doing. I mean, it falls on me sometimes to do that. I take the balance sheet and then I do like another column with a pro forma view and we try and get a valuation of some sorts of, hey, what's this thing going to be worth if we turn around and sell it right now or 2 years from now? And then let's put that in there and show that addition to equity and see what this thing really looks like. And then when you run a debt to equity equation, it doesn't look so bad, and it actually makes it as a reasonable debt target. But unless you do that, otherwise will tap out with debt to equity. It'll go way beyond 5 to 1, which is like our absolute max, or you're dealing with negative equity to begin with, so you can't even run a number. But when you bring in that pro forma view of the brand value and or the distribution chain that the entrepreneur has created over a period of time, and give them credit for that, that can change the whole picture.
Right. So I wanted to capture that, and I wanted to ask Andrew. He just used a couple of words that angels don't process at all, right? So where in the QuickBooks can you go to get his pro forma value of the company?
QuickBooks doesn't have a pro forma. Pro forma is essentially your future looking financials. And so that's more like the financial model than the QuickBooks income statement or anything else. Maybe when you're looking at a pro forma, that would be more like Sharish's 1 or 2 year model opposed to the 5 year model. Particularly with lenders, they don't like to see that tripling every year and huge growth. They want to see consistent, steady cash payback. And so I think that forecasting more conservatively for 2 years is going to be more believable to a banker.
Well, I think what Roland is doing is he's looking at the infrastructure of their business process, brand and distribution and contracts, and he's assigning a value to that, and he's putting that essentially on a virtual set of books that represent what, if you sold this company in a little while from now, all of this value would be paid for by those people. So why don't we use that value that the investors would buy when they bought the company as a foundation to make a loan? Am I getting it right, Roland?
Pretty much. I mean, in this one that we're just doing now, I actually asked the owner of the company, if we had to turn around and sell this right now or a year from now, what would you get? You've been in business a number of years now. You probably have talked to a potential buyer or a competitor who might buy you, or you've seen other competitors be sold. What did someone of the same sort of size and same type of setup, what did it go for? And they gave me a number. I mean, they already know in their head more or less what it's worth. If they don't, that's where you have a problem, because they should.
Absolutely. So, Garrett, what's the value of your company?
Value of the company is we are changing the way that the cycling industry deals with customer service and buying parts.
No, I was asking a valuation. The answer to this is a number. What's the valuation of your company? You have a company, it does things with bicycles, you're going to make the world a better place, and it's worth how much?
Today, I'd say we're probably worth, or I would like to go raise on like a 1.2 to 1.5 million valuation.
Okay, that's good. So what kind of revenue you have right now?
So we're not fundraising right now because we don't have revenue and I don't have LOIs in the back pocket to go do that. So that's kind of the holding out and trying to get some deals with some of the bigger players.
You should come to our Tuesday open coffees and we should talk more about that. So Andrew, here's a perfect example of an entrepreneur. He's got a great idea, going to change the world, going to be a big company someday, has no revenue. What's the value of his company?
Well,
It's not zero.
Yeah, so the financial value may be very hard to ascertain, but I would say that the best way to get a valuation is to have an I love you conversation with an investor. And so what I would do is I would find someone who's super excited about what you're doing, and it's an investor, and that investor might say to you, hey Garrett, I love fresh grease and I love you. And you might say to your investor, I love you too. Let's do a deal together that's fair and great for everyone. And we need $500,000 over the next 18 months to hit our next milestones before we can do fundraising. And because we want this to be fair for everyone, we want that $500,000 we want to sell you 25% of our company, which is just a really great amount for you to own post-funding valuation, right? And the investor's like, well, I love you so much. Are you sure me taking 25% right now is fair for you guys? And are you sure $500,000 will last you for 18 months, right? And then you guys go back and forth about, you have that Canadian conversation where you're all trying to apologize for each other. And then the next thing you know, boom, you got a $2 million valuation. And so I like founders to find people that are excited about their company, excited about their milestones, and back into the valuation based on what they need, and have the investor have the belief that this business is going to be so big in the future that today's valuation doesn't really matter. As an angel investor, getting in early matters a lot because that's your chance to take the biggest bite out of the company at the cheapest price. But at the same time, if you got a $2 million versus a $3 million valuation and the company sells for $1 billion, you're probably not going to care that much if it was 2 or 3 million. It matters if the company doesn't do well. If you got a $2 million valuation when you could have got a 3 and it sells for 4, you're going to make a lot more than you would have if you got a $4 million valuation when it sold for 2, right?
Yeah. So Garrett goes and he finds someone who loves him. Let's pretend John loves him, and he gets this investment, and he's got a $2 million valuation. Maybe John doesn't write a $500,000 check. Maybe he takes less of the company, but nonetheless, he goes to Roland and he says, Roland, I got a company that's worth $200,000 or $2 million. I just proved that because I just sold some stock and it values us at $2 million. Does that count as valuation for you to give them a loan, Roland?
So we don't do it quite that way because
I know you don't. That's why I'm pressing.
It's great that you got a valuation like that. I don't know that you would be our client. It's possible, but what we're looking at is that 3 to 5 year pro forma, even if you haven't done any sales yet, but it's better, if you have at least a year's worth to go by, where we see increases. They're not necessarily doubling every year. Let's say your gross was 100,000 in the first year. What's the real chance we see you doubling to 200,000 in the second year? We don't see it all that often, but we do see people get up to 1.5 times.
In our world, that's a really bad company. We're sad when they don't double in a year, right? We want triple, or in the early days, we want like 5x, right, or 10x.
But what happens is when we even build it out that way and we start seeing that happen, we know that these are the ones that are outside of the usual model. And so if they do it even 1 year and they do that like more than double, maybe triple, these are the ones that are going to go that distance. So having that year to year and a half track record, 2 years, really says a whole lot about what that 5-year picture is going to look like. And then you can do the math and come up with somewhat of a pro forma of here's where this thing's going to be in sales at the end of 5 years. So based on that, based on what the sales are at the end of 5 years, how much infrastructure will they have built out and what's that going to be worth? And how much brand recognition will they have built out and what's that going to be worth? And probably you need to also turn to people who are industry experts there or find comparable sales, and then you know what the things are worth. then you could compare it to, somebody just put $2 million in. Did they just make a good deal? Because in the 5-year picture, it's really going to be worth 25 million, or it's going to be worth 15 million. I don't know. But we sort of go from, let's see that first year to 2 years and how that goes and how much, happens in terms of growth, because it's under 10% of all the deals we ever see go more than 1.5 in growth per year in our client base. So,
so part of the reason that I'm asking is Carlos is saying he's having a hard time getting angel money to do stuff, and so he's a client that would like to see some particular alternatives to the normal angel process at some level. Garrett has enough of a strange business that normal straight down the middle investors sort of have to take some time to wrap their head around it. That's going to slow him down a little bit. And so having alternative choices for investment seems like a worthwhile conversation. That's why I keep pulling you in. But what I got out of this conversation is that Andrew and you don't talk very often, that Andrew doesn't do CDFI things and you don't do Andrew type things. So I'm wondering how we can get some sort of synergy there and get things to go. Anyway, thank you for indulging me with my little thing. Does anybody else have any questions now that I've stirred the pot?
What day was open coffee? Thursday?
Tuesdays, Seattle Startups Open Coffee, Tuesday at 8:30 a.m. It's a meetup group. And we do this kind of chat every Tuesday. Or send me an email and I'll be glad to link you up. Jason, you said something important in the chat. I'd like you to say it out loud for everyone. Can you come on and say it?
Which specifically?
The idle fund.
Oh, so the economic injury disaster loan, it's a 30-year loan, 3.75% fixed interest, can only be used for working capital. So for operating expenses only, and very, very strict rules about what it can be used for. But it's great for making payroll and paying rent. Those exact kind of overhead costs that a lot of startups have when they are early stage, maybe even pre-revenue. That loan program has been around for decades. It was created back in the 70s. A lot of people think it's a new program, but it's not. And the COVID-19 pandemic, I don't know if it was the first ever nationwide disaster declaration. I think it might have been since the program started, but it made every zip code in the entire United States, all 50 states and all 5 territories, disaster zones. And so any business that was in operation, meaning incorporated and legally operating before the disaster declaration, I don't have the exact date in front of me. I believe it was February something of last year, but double check that with your accountant or your attorney. But you're probably eligible as long as the business was incorporated or organized legally and was operating. And the loans are up to $500,000. And again, that program, it was given additional funding because of COVID. But it's not a new program. It's been around for decades, and there's still funding available. And so if your startup existed like before last year, talk to your accountant or attorney about getting access to those funds, because they're amazing loans. I did one for $150,000 just in case. I ended up not needing the money, even though it killed my seminar business, and so I just paid it back. But if you actually need it for working capital, they're amazing loans. So again, talk to your accountant or attorney.
Cool. So Andrew, you've been spending a lot of time filling out forms for the various government programs.
Yeah, we've done a lot of them where applicable for the EIDLs. Well, we probably also did over 200 PPP loans. My understanding, though, is that PPP money is out, and it's kind of too late now to get more of them. Right now, we're focused a lot on PPP forgiveness. And if you did everything through Gusto with auto compliance, it makes it really easy.
Cool. Roland, you have your hand up.
Yeah, I just wanted to second what's being said about the EIDL loans. So originally when they came out with those, I mean, this is an SBA product. It's correct with SBA, Emergency Injury Disaster Loan, EIDL. And it is one of the best things that's out there. We had a lot of our clients get them. They actually use that working capital to pay off some of our debt because it's like 30-year capital at, what was it, 3.75% interest, and the first year was deferred. So, you know, fantastic situation. And that is still out there. When they first came out with it, they only allowed out to 150,000. Then they used up, I shouldn't even say first year, first few months. Then they used up all the money that had been allotted, and they shut the program down, and everybody thought it all went away. And then they came back and put more money into it, reopened everything up, and raised the limits. And then people who didn't get as much were able to go back for more, and some people were able to just go in for the first time. And it is still open, so it's an excellent alternative. And I think the deal was you had to have been in business on February 15th and then affected by the COVID thing, like your doors had to be open then. And then if you shut right after that, you still qualified. But that's an excellent, excellent SBA program, and it's wide open to a lot of folks. This new capital I was talking about earlier is connected in some way to all the legislation that happened during this past, whatever, 14 months or so. And it's come through the state level, and now the state is going to be turning to the various CDFI groups to try and get that money out. And again, you know, we're looking at 4 to 4.5% capital. Well, in most of those cases, those loans will be made, and then 95% of the loans will be sold to investors, or back to the state, I should say, as the investor that will hold the paper, and then the CDFIs will be maintaining just more of a servicing role in those. So that's what's sort of on next. It's like a follow-on thing from PPP, because that's no longer around. That ended May 28th. SBA ran out of money and cut it off 2-3 days early. I think we did like 700 of those loans. It was really intense period of time. Yeah.
Yeah, all the accountants seem to have been pretty busy last year. All right. So one of the things I want to get people to get out of that conversation is that there's more than angel investing as a way to do fundraising. And there's a lot of ways maybe to sell less equity and to get debt or other instruments that will help carry you over to your next milestone. I think the thing that I would like to see in the financial model is the financial milestones that you put in the money, and then the money comes back out because some milestone was achieved along the way. And I think that's really important in your financial model. And so Andrew is one of the people who's done enough of those that can help put those together. There are bunches of other people, but think in terms of the business, not in terms of the project. And we'll see how we can get more investors to write checks and more companies to get checks. Again, tomorrow morning at 9 o'clock, we're doing where can you get data from the Seattle Public Library and the state of Oregon and Washington data sources that we've got. We also have a food and farm finder conversation. Ollie's gone, but he should go to that. On Thursday, we have Jane Lee Cho doing the journey of her journey. And next week, On Tuesday, we're doing the Meet the Angels talk, where we're going to have as many angel groups as we can get from the area into the chat. So thank you for coming. Thank you very much, Andrew, for giving us this talk, and I look forward to doing more.
Thanks so much.